Today we're looking at the S&P 500 setup into the second half of the year. We'll be looking at 4 key factors that have helped us get to this point that we'll need to see continue for the second half to be just as good as the first. So before we can really get into the second half, we do have to consider where we're at now and how we got here. And so right now, we know we just finished the third straight up quarter, and now we're up 6 out of 7 quarters. Very good run. A lot of people think it's too good at this point, making new all-time highs, but as we can tell, looking back 30 years, this really doesn't stand out at all. Just coming off of a time where we had 7 straight quarters back here from 2012 through all the way to 2017, had 9 straight quarterly advances twice. We go back, of course, to the late 90s, right? Up 14 straight quarters. Pretty big dip in 1998 there, right? And then another 3 quarters up in a row. So 17 out of 18 here, 19 out of 21 overall before things fell apart. Now, each one of these occasions, of course, there are people calling for the demise of this uptrend that has gotten too far, too fast. And at some point, we did have that pause. We did have some pullbacks along the way, some meatier than others. Every time the index extended longer than a lot of people thought it should. And so we shouldn't discount any potential scenario at this point, but understand the factors that are in play right now. If they start to change, that's when we should get concerned about things changing as well. So let's talk about my favorite, of course, successful bullish patterns. And it's been clearer that things have worked in our favor in this regard. We know that from the S&P 500 perspective, there have been numerous bullish patterns out there, and 7 of them have achieved their target already. Now that's good to know, but we need some context around it, because if you have 7 successful bullish patterns, odds are not too many bearish patterns are working. In fact, we've had 0 so far. And we talked about these along the way. And what this really means is there's going to be periods of times, of course, when the market consolidates after a run. At any point, one of those consolidation phases can turn into a bearish pattern, or at least get resolved to the downside. That just hasn't happened. And we talked about this in terms of trading boxes, a very easy way to look at it if you don't like classical bearish or bullish patterns. Just seeing a sideways range, having a breakout, obviously bullish, having a breakdown bearish. What have you had over and over again so far? Bullish breakouts, right? And these are all 7 that have taken place or formed since the low from last fall. And 6 out of 7 of them have had their upside targets achieved so far in 2024. Now, these started to take shape beforehand, but you can see all of these have been in place and have their targets acquired since that point, where we still have 2 more that we don't have listed here that are in place. And that's one of the biggest differences between now and, say, last year when the market topped in July. At that point, we didn't have any more bullish patterns. So really the market just petered out after that. And the biggest one so far continues to be the 6100 target that we had triggered back in January. And with the market so far above that 10%, it's going to be with us even if we get a deeper pullback at this point. And so just as important as this, as we know, is rotation. And there's different ways of looking at this. We know their sectors have led at different times, but I think one interesting viewpoint is this. We just looked at how many days technology has been the leading sector since the beginning of the second quarter of 2024. And so there's been 64 trading days since that point, and in 17 of them, technology has led, by far the most frequent leader, if you will. And no surprises, that has led to some of the biggest gains on a daily basis we've seen over that time. And we know that technology is more than 30% of the S&P 500, so just by the math, that's going to happen more often than not. But as we can see here, there is a lot of red in this column, which just shows breadth, right? So the percentage of stocks that are up or down. And so from this angle, we can see that not every time technology led did the rest of the market follow suit. In fact, only 6 out of 17 of these days did we have positive breadth, but technology led 35% of the time. That's pretty bad. Or is it? What does it tell us? So it tells us that when technology has led, not everything has followed suit. And every time that's happened, of course, there's a bearish headline around it. And we can't ignore that fact, because if the market is thin, at some point, technology may catch down to it. So on days when technology has lagged. It has led to some of the biggest declines we've seen, right? Down 1% in April here. But as we can tell, most of the time, the rest of the sectors, the field, stepped up, right? 7 out of the last 10 times, in fact, 7 in a row, but technology has lagged or has been the worst performing sector. We've had a positive breath. In fact, there have been some of the biggest days over the last few weeks have been on days technology has lagged, which tells us emphatically that there is a good amount of interest in other sectors to help the market in days when technology has really not been there. And so it doesn't happen a lot, but it happens when it needs to. So the question is, what do we need to occur going forward? Well, 2 things. Technology needs to still lead overall, or at least be among the leaders. Again, it's just math. If all the biggest names start to fall apart, it's going to bring down the NDX, it's going to bring down the S&P 500, and could eventually bring down the rest of the market as well. So on the times when it lags, we need to see, again, this type of action where there is enough support for the other sectors to keep the market higher. And this is a perfect example of when that occurred. From the middle of January of 2024 to the end of April, technology underperformed the S&P 500. But there was only one specific time, right, from the end of March to the middle of April, that the S&P actually got hurt because of it. And that's when the whole market got hit. Other than that, other areas stepped up, and that's what's really kept this uptrend going. And so low two-way volatility, we're talking about this on a monthly basis. And so this has given us now through the beginning first 6 months of the year, 15% gains, 7% losses. That's a very small amount. In fact, we've gone now 17 trading days without 1% gain, which is the second longest span without one, the other one being from mid-November to mid-December. And so for some context, looking at the last 2 years, it's even a lot less than we had last year at this point. Almost half, actually, right? 26% gains, 16% losses. Where you had the volatile start to the year and then a pretty strong rally as well, which got us there. And then, of course, 2022, much different environment, 31% gains, 37% losses, again, at the halfway mark at this point. And so why do we look at this so often? Because when we have low two-way volatility, it just means that there's fewer whipsaws. Fewer whipsaws means that you have cleaner breakouts. And when you have cleaner breakouts, upside targets get hit more often than not, which brings us back to that first chart when we saw the 7 successful bullish patterns. That has been able to happen because of the low two-way volatility. And lastly, good closes. Now, we talked about this chart before, but I think it's important to update us. And right now, you still have a very good clip where at the beginning stages of this rally, the win rate, meaning that the times when the S&P closed above its intraday midpoint, close to 80% through the beginning of March. Then we had that downturn. We talked about how it started to change first on this side without seeing the market roll over. So you started to see some closes underneath the midpoint, started to see the market kind of close near its lows a few times before things rolled over. And needless to say, it's a different type of environment where you have only 40% of the time. And then since that point, it's been consistent again, not quite to where it was before, but close to 70%, which is going to give us the type of uptrend that we have. And so you may not want to focus on the short term, or some people don't care about short-term trading. That's fine. But we have to understand that the crux of this entire market starts with the very short term, because the biggest institutions, the ones that run billions, trillions of dollars, need to be interacting and trading every day. So that means their bigger picture view is executed in the very short term. So if you believe that the market's going to close higher that day, into the next week, into next month, that means your strategy for trading is going to be continuously buying, even at higher prices, as opposed to the opposite, which are being patient, thinking that the market's going to come down to the price that you want, right? And so when you have that consistent buying, when you have those good closes happening on a persistent basis like that, that is how an uptrend is constructed. And so all these 4 factors have been working together. If one or two start to change, it could eventually affect the others. And that's when we could have a more material shift in the trend. That's it for today. Don't forget to check out these videos and subscribe, and talk to you next time. Thank you.